Hello, guys. Welcome back to the channel. With me today, Patrick, Karim, Bear Charts. And as I mentioned in the tweet yesterday, this was one of the first account that I followed on Twitter like 3, 4 years ago. And I've been talking to Patrick a few times on Skype or Zoom before. And his charts, his technicals has improved me to become a better trader and a better investor, most likely. So definitely, Patrick, personally, for having you on here on my channel is means a lot to me. So thank you for tuning in.
Well, thanks, Gasper. Look, you've been putting great stuff. Your YouTube channel is growing, and it's all about. It's like it's the grind, every day. And you love doing charts, and you're immersing yourself, and that's how you get better. I remember back in the early days, I was very enthusiastic, still am, but I would try a whole bunch of different things on the charts. I do the Fibonacci, the fractals. I went bonkers. Like I explored everything. But I've realized over the years, and I kind of knew it, it's this when you keep it simple, it's like it reduces a lot of the noise, bring it down back to the price action, moving averages, a simple trend line. And that trend line will tell you when the odds have shifted from low probability to higher probability of the roadmap. You don't need much more than that, right? A trend line tells you so much information. It tells you about momentum, it tells you about velocity, it tells you when momentum's slowing down. So that's all you could have for a chart trader. And I don't know people who aren't chart traders. I don't know how they do it without looking at the price chart, without understanding price expanding away from moving averages, increasing in velocity. I don't know how people could visualize that, or when the momentum's slowing down, how they could visualize that also and get their chips out if they're just doing news-related trading or fundamentals without actually looking at the price chart. So look, yeah, it's all good there. And yeah, let's dive into it if you want there. Maybe we could cover gold, silver, uranium, right? I think people want to hear about what's happening with
Yeah,
that.
yeah, that's the big three that I cover on my channel, also on my Twitter, among others, of course. But definitely those three are kind of big topics. But first, before you go in, Patrick, here, could you please let us know where people can find you? I mean, most people know who you are and so on, but for the newcomers, where can they
Yes.
find you and what do you do?
Well, they could go, guys, on the Bat Charts One on Twitter, post a whole bunch of stuff there with Kevin Wadsworth, North Star
Yeah.
Charts. We have a website called northstarbatcharts.com. And there's more in-depth stuff there, handle chart requests, and we have a trade tracker where we have our officially tracked trades and all that. But those are primary two places. I have a YouTube channel also, which we should have you on there for a second time, right? Because I remember
Yeah,
we
second,
did
yeah.
I did have you back in your early days. It'd be fun maybe to re-invite you there on our channel. And that's pretty much it. Sharing, learning, and observing and repeating that cycle, so we all get better and get better odds in our favor when we're in this crazy financial world there.
Yeah, it is definitely crazy. If 2023 was crazy, I think 2024 will be magnitudes
That's right.
of what we have seen. So yeah, definitely. But yeah, Patrick, do what you do best, showing charts with great visuals. So gold, silver, uranium, and let the viewers know what you think will come. Where have we been? Where we might be going in 2024 and beyond.
Well, look, let's start with the big picture gold chart here. It's on the monthly time frame, and here is a log scale. I think that's the 14-year, 168 month. That's 14 years, right? 14-year moving average. I know it's super long, guys, but it doesn't hurt to check it once in a while to know if you're stretched above that long-term moving average or coiled and tight and breaking above it. Because I'll tell you one thing, look at these tops here. Gold had in 1970, mid 1970s, 80s. Look how stretched it was from that 14-year moving average. Doesn't mean it can't go higher, but you've been running hot for a while. Look in
Mhm.
2003 when it broke out above that 14-year moving average, and then when it peaked, it was stretched above. So just being stretched above doesn't mean it's peaked, but if stretched above and you're breaking down below um rising trend line, breaking below a horizontal support, then you're actually losing momentum. And look where we are today, coiled and tight, still not too stretched, but we're starting to stretch. So this is what you want to see, right? You don't want to see this. because you're coiled and tight, doesn't mean you want to go long. But what you want to see is coiled and tight and starting to expand, not ending expansion, starting to expand. That's where you get the capital flows are going in, and you have a lower risk, high reward proposition. And here at the bottom, I have a custom stock. And guys, you could do that all the time. Instead of using the default stock values, I just put in 168 months just to match my 14 years. So this is a 14-year stock indicator. And you can see what happens. You could clearly see when you do some TA where there's resistance here. Once you break out above, that's the transition. So once, as a chart trader, you want to spot these places where you're from bear zone to bull zone. Here, this breakout here above, just like it did back in 1971. That's the low risk. And now it's expanding, Nobody believes. And then it overheats until it totally breaks down. And then it goes back down. And here it could have failed. But what happened here, it actually bounced on this historical median pivot line here. The pivot line, guys, is when you test from above and below, dating back to the late 1960s. And look what happened here. Here we had a super scare. It was really starting to fall low, just like it did in 2008. It was that severe. The correction we had recently, it was almost like a 2008 type correction.
Yeah.
And but look at that. It's just rocking upwards. So now people got to take a deep breath. Gold's back in the power zone. We're in these type of zones here. And until it really crashes and starts heading much lower, then the bias has to be bullish. I know some people have bearish targets, but how could you have a bearish target when you're in the overheating power zone right there? You're in the heat. You're in the top zone here. You're not too stretched from the 14-year moving average also. So gold's got a lot going for it. Even here on the nominal chart.
Yeah, exactly. Yeah.
I have here the monthly candle. Look, what do you want me to tell you? It's a clear breakout here. Last 2 months ago, even in the close of November. Look at that noise here in the wicks. Oh, went up, went down, retested, and it's just trending higher. It's like nothing to see here above an inclining 12-month moving average, above a 3-year moving average, above the Ichimoku cloud, above a high volume node. It's an uptrend. It's like you could have bearish bias and hope it goes down, but for it to go down, it has to break below the 1 year, break below the 3 year, break below this possible rising trend line because it needs a third reaction, break below the cloud. There's a lot of, you see, every time I'm adding something verbally, it's a bearish milestone it needs to accomplish for the chart to look bearish. Right now, what it's doing, it's the opposite. It has overcome practically all. Look, even here, I'll put on the yearly because we just had a yearly close. Reset chart view.
Yeah.
It's like it's just we had that's like a pull flag breaking out confirmed last like a few days ago. What else you guys want?
Yeah, exactly.
What do you want me to tell you? I'm not like
yeah, as I say often, you have to be bullish until proven otherwise. I mean, and for
yes.
now, also to me, the way I do things, I mean, gold is bullish until we get some severe breakdowns, and then of course we have to flip. But for now, you have to remain bullish, and daily, even weekly price action is just noise in my view. This is a longer term trend, so yeah.
Yes, it's definitely longer to trend. It's just look, of course, people they could be like, remember March Madness here in March of 2020, gold went down super much, it went up super much, and if it ended the month flat. But here, the COVID panic, you can't even see it in the gold chart here. In the yearly candle, it started low and it closed high. It's like even here, tell me where GFC is, the Great Financial Crisis, guys. It was right here. But it's a wick. It's a gold racked 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 straight years start green candles. So even that the uptrend, even if there's a recession or something really scary, you're already in an uptrend. And those capital flows, as defined on the yearly candle chart, will offset a lot of the bearish news, of the recession news, or like the Great Depression, or like the Great Recession, all that. There's a trend in place that started way before that that's carrying it upwards. So the longer gold is an uptrend, and somebody could make a case that we've been in an uptrend since 2016 here. It's just in an uptrend. It's had like it's went up or sideways for the past 8 years. Like that also is very bullish, right?
Yeah,
There's
sure.
nothing. It's in a clear uptrend on the year time frame. Silver. Well, let's go on the monthly chart for silver. This is a chart I like showing everybody. Before I just show you the silver chart, I'll just show you what silver tracks. You probably saw me do this chart a few times.
Yeah, it was a great chart. One of the better ones for sure. I also retweeted it and showed it on my channel here. So definitely, yeah,
Look
exactly,
at that, guys.
exactly.
It's like
Yeah.
I know, bullion bags, I Mr. Slammy, all that stuff there. I hear you guys,
Mhm.
but supply, there's not enough silver, solar panels, everything. Inject all the narratives you want in there. Here is silver, the one I'm shaking, and here on top is gold divided by inflation. So gold's capacity to outperform inflation is what silver tracks. Look at that, guys. I'll do it. I'll zoom it out all the way to, oh goodness, let me put the,
Yeah, it's even better long term. I mean, it's just
yes, it
more
tracks
or less 1 to 1, right? Not 1 to 1, but definitely very, very high correlation. So it's
XAG
beautiful.
USD. Oh, yes, exactly. It's like, it's so remove drawings. Look, I'll just put that in black line here. Look, silver charts, the candle chart in the background, in the front is gold divided by CPI. So, okay, so there's two things a chart trader could do. Step one, just look at the price chart. What's happening to the silver chart? Let's help you guys out. Let's do it right now. There was this line here,
Yeah.
which had a break. So that momentum, as defined by that declining trend line, broke out, and then the price backed up, closed slightly below it with a wick below it. Now we got to see the next month what's going to happen. And this swing high here created another less steep breakout line. And like that's why people got to notice when you use the word breakout. Yes, a trend line that's broken, you could say it's a breakout, but they have different components attached to it, different significations. So this is less steep, this line, than the other one. So the more every time silver's growing higher until you get to that horizontal breakout line,
Yes,
which will
exactly.
be the most meaningful one. There's one here at 20, 25, another one 28. That's flat. That means there's no more downwards momentum. It's a flat plane, and that's easier to let the price. There's less downwards pressure. So it permits the price to actually go up, to retest from above, but not lower. Retest from above, and then after that, you get some crazy moves, guys.
Yeah.
Just like we had back in 2008. You see, it broke out, but the next month it got a severe retest, goes up, severe retest with 3-year moving average until you had a flat plane or almost flat.
Almost. Yeah. Yeah.
Yeah, it's starting to flatten out. And then here it was flat on that pole flag. And look what happens after. It just vacuums up, just vacuums up
Yeah.
because that downwards, it's like, it's all mechanics, it's physics, it's mathematics, all that downwards pressure is gone. And then after that, you get these beautiful reverse symmetry moves. So silver's there. It's waiting for gold to break out versus CPI. And I'll just do gold versus CPI on,
I think it's pretty close as we speak, right? I guess.
oh goodness. Look, it depends how I'll just double click here. I'll put it on the candle chart.
Mhm.
There's a few ways to draw this. Somebody could even say this declining trend line was broken out, retested. Then after that, you had another one, less steep, broken out, retested. And you could even say that even here now it's starting to gain flat planes, zero momentum. But the longer the flat plane is, the more reliable it's going to be. So the ultimate flat plane, it's if ever gold outperforms this inflation and breaks above this
Yeah.
plane that's lasting 14 years, that is going to be a massive cup and silver tracks this. So this is probably when silver is going to break out above its all-time monthly
Mm.
defined highs, above $40. That's like the most bullish roadmap you
Yeah.
could have here. Maybe another cup here. That's what leads to my crazy roadmaps of $800 or like 100 triple digit silver. But that's down. It's not going to happen now. And you don't
No, no,
want it to
no,
happen
no.
now, because if it happens now, you're going to be stretched from the moving average. You're going to be in blow off top territory,
Yeah.
and you're going to create some damage where you're going to need time to heal, right? So this would be, look, these are great gains. Even if gold just goes like that for the next, until next September, the next 11 months, 8 months, these are great gains if gold's able to do that, because that
Yeah, for
means
sure.
silver is going to be back at its all-time highs there in the next 8, 9 months there. if this trajectory can keep going upwards.
It's also a beautiful move from 2000 into 2011, and then you have this big, cup and handle play in the
Yes,
making. I mean, it's
goodness.
just from a price, point of view, formation point of view, these are very, very strong
Ah,
formations about to be to be made real here within, a few years, I think.
yes, monthly candles. So 12
Mm.
candles, one
Yeah.
year, it plays out. But I always rather, people have to decide, do they want to look at the chart every single day or they want to look at it once a month? Because if you look at monthly candles, all you have to do is you live your life with your friends and family. And once a month, you come and check, you see if you
Mm.
have a breakout or a breakdown. Once a month, 12 times a year, you have to look at a chart. You decide if you want to make your life complicated or not. So most people, we have day jobs, like people, well, my day job's just doing charts all the time for North Star bat charts, but
Mhm.
like anybody, just go on the monthly chart, and then once you get these crazy signals that don't come out too often, then all you have to do is just write it up, write it until the chart breaks down, and once it breaks
Yeah.
down, then you're out. And if it ever it was a false breakdown and it re-breaks out,
Just buying
no,
again.
just yeah,
Yeah,
yeah, it's
yeah,
like so
exactly.
hard for people. It's like,
Yeah.
oh, I have to hold it through the down. No, get
And
out.
yeah, and even if you miss like 5%, who cares, right? It
Ah,
doesn't matter. So, or 10%, it doesn't matter really. You reduce the risk and your long-term
yes.
pain, let's say. So I agree completely.
This is the pay dirt. This is what you want to trap. You
Yeah.
won't sell at the top here. You're going to sell maybe here when it breaks down. You're going to enter here like this. This is the pay dirt.
Yeah.
This is what you want to trap. You don't care about this. This when people say, "Oh, Patrick, you missed 50% off the bottom." I don't seriously don't care because for me, the lower risk to create an uptrend, you need to have higher lows and you need to have higher highs. But you cannot have higher lows at the bottom. A low will always be a lower low. So you need already
Yeah.
a higher low to start an uptrend. And then you need a horizontal plane breakout because a horizontal plane breakout confirms that you have a higher high. And that's an uptrend.
Yeah. A
Higher
long-term higher
highs,
high. Yes.
higher lows, and
Mm.
that's what you want to ride, right? You want to ride these this is pay dirt there.
Yeah. And I
Uh,
think, the past 3 years of sideways consolidation will soon get rewarded. We're about to break that 2K level for gold. We have broken it, but convincingly we are about to gain traction here. And
yes,
definitely, I think, the next few years, I think gold will do tremendously well. And I have, that cup and handle for the past 3 years. Excuse me, inverted head and shoulders for the past 30 years on gold. That points to 2,600. And
yes.
that's, I think that's not out of the ordinary in the short term. Longer term, I think we're going higher, but definitely that is a good target here for the next few years, I think.
That's probably going to be the next profit taking zone. Will be
Yeah.
around that
Yeah.
2,700, depending how fast it gets there. If it
Yeah.
really goes up fast, then that'll be on the lower scale of that price range. And if it takes its time to go up, then you're going to let that moving average catch up and go up with you. So you'll be able to maybe get 2,700,
Mhm.
2,800
Yeah.
before the next important, 2-year correction or consolidation.
Yeah, exactly.
Let's move on. Maybe uranium. Uranium is just bonkers. So I'm using the
So strong.
physical
Yeah.
Sprott. I'm pretty sure that tracks the futures.
Yeah, more or less. More or less,
Yeah,
yes.
more or
So
less, right?
yeah, yeah.
What's the correlation to this thing there? Indicators, correlation, coefficient, and let's put UX. I used to have a great data feed there. That I used to get on QuantDL. I used to
Yeah,
have
yeah, yeah.
spot uranium going back to the 80s, and that's broken now.
Yeah, exactly. I tried to use it like a month ago, and
Yeah.
it didn't work. So I was like, damn, man, I would have loved to use that data, going so far back. But yeah,
Ah.
it is what it is.
So here is the correlation between Sprott physical trust and uranium down here. So if anything above 0.7 is good, but a perfect correlation you'd be here like, so yeah, you're right. There's some periods where the correlation is neutral to none. But recently, the Sprott Physical Uranium Trust has been tracking uranium futures
Yeah,
pretty good. So let's do some TA on that. The low risk, high reward entry for uranium was here above the 1 year, above the 3 year, above the Ichimoku cloud. That was the longer term trend line. That was the low risk entry. Low risk entry here was the second low risk entry, this consolidation above the 1 year, above the 3 year, coiling right above the 1 year, and bam, crazy explosion. And yeah, it's starting to be in overheating territory. It's starting to reach its targets. It's like really close to its measured moves. It's stretched from both moving averages. It's not, there's absolutely no low risk entry here. You're probably closer to profit taking zone before you get some other type of consolidation pattern here. Is it shorter or longer? Something's going to happen here eventually to let those moving averages catch up, because I'll show you something. Here's the distance from the 3-year moving average.
Oh, okay. Nice.
It's stretch. It's as stretched as it was from the previous crazy explosion it had. So statistically, it would be, look, I know in the 1980s it got stretched probably higher than that. I know in the early 2000s, like this thing's able to get stretched there. If we would have had that here, the distance from 3-year moving average, it would probably be here or higher. We could even, I'll switch up to chemical, because chemical could give us some indication on how stretched that could be. But it's stretched now. It's definitely stretched. So you got to expect something to happen there. Let either sideways move, let the moving average catch up, or hard correction, let the moving average tag it, and then bring it up. But it is stretched. There's no low risk entry here.
I also think, if you look at the spot price itself, I think we're coming very close to the $100 level. So you're going from 2 digits to 3. That's typically also major resistance. And also we have a big gap down in 2011, which we're about to hit. So I also think that we are closer to the end of this move than the beginning. That is for sure also my take. So
for UX, what's wrong with this thing?
Yeah, it looks.
Oh, here. Okay, here, UX. Because here in TradingView, you could have it there. It uses the, it changes settlement date. So I think it gap fills better than if I would just use the.
Okay. Yeah, it looks weird.
Yeah, and there's another one, adjust for contract changes. Yeah, I've been playing around with that. Goodness. All right. So here it is, the UX, it's stretched above its 3-year moving average. Yeah, it's bonkers. You could see though, here's Cameco back in the 2000s, and it got really stretched. But statistically, you see one time here, that line 108% above the 3-year moving average. Here, it halted. You see it did a correction here. It broke out above, retested from above. So if it's able to stay above that, then you're overheating. But it's stretched. It's by all means there. This thing's it's pretty stretched. So there's no low risk entry here. You want that rising support to continue upwards. You want to bounce here. And then after that, you could probably have another go at it. I've been looking a lot at Cameco there. You got to be careful, because sometimes you have higher highs on the price, but it's refusing to do a higher high on the indicator. So while the price is going up, it's not able to go up as fast as the moving average is catching up, which is not the end of the world, but that's step one. But after that, once you get a breakdown, then you have to say, okay, something's wrong. I had that bearish divergence, and now I'm breaking down below rising trend line. So here you have it here a little bit for Cameco. But as long, if ever breaks down below here, it's probably time to take it's gonna need a bigger pause there. So you got to wait. People could definitely take profits here, just like, but it's easy to take profits. I'm telling you, if it's hard for you to take profits, it's because you probably bought too high up. Anybody who bought at the breakout here, they're psychologically they've made their run, right? But anybody who started buying here in the FOMO, people saying, oh, it's like uranium's going to wherever.
Yeah.
Without looking at the charts, without looking that it was already starting to get stretched, then they're kind of trapped, because psychologically it's very tough to sell, right? Here, the low risk entries, look at that. That was bonkers.
Exactly. Late 2020
was just tight. It was.
Yeah.
See, this is where you want to buy, guys.
Yeah. That's also where I purchased like 80% of my position in uranium miners and so on, late 2020. So that was just a perfect entry.
That was the first low risk entry. I'm telling you guys, we might have one more consolidation, but these legs, there's not 100 of them on the monthly time frame. Look here, it had a breakout one leg consolidation, second leg consolidation, and then you had 3 runs. So we already had one. Now we're approaching resistance. Even on the yearly chart, remove drawings.
Yeah,
Here's a
we're
yearly
getting,
chart for
wow,
Cameco.
that's well defined. Yeah, nice.
All-time highs yearly defined. So this could now be support. Let's see what happens. One, two, it's maybe not a clear trend line. We'll have to see what happens here. Could start rough at the beginning of the year, and then after that, maybe go up. But you're at resistance levels. Even on the yearly
Mhm.
chart, you're hogging around resistance levels, which is not the low risk entry. The low risk entry was 2020, right?
Yeah, 2020. Yeah, correct, correct, correct. So yeah, I mean, but still, I think there's definitely room to run. I think the mid-sized uranium miners and the smaller ones hasn't run yet. It has only been the blue chip. So
Yes.
hopefully we see that dribble down, from a money point of view into the smaller ones. And when all the small nano caps, the ones that hasn't got anything to do with uranium, once they finally blow up to, with huge gains, I think that's when we will start to exit the uranium trade, I guess.
Yeah. What do they call them there? The shit codes.
Shit
Did
codes,
you
yeah,
see
exactly.
yeah, I know. I shouldn't say that, repeat that word, but it was so funny there. It's like, yeah, when everybody gets excited with penny stock gains, but
Mm.
this is the thing. People they should be in Cameco. There's no reason to be in anything else other than Cameco. Cameco's like, you've had gains forever for Cameco. The money's flowing in there. Maybe, yeah, maybe the smaller cap stocks will get a chance, but some of them, maybe they won't.
Yeah,
Maybe,
exactly. Exactly.
maybe some of them will some are terrible. You could look at any previous bull markets. There's Cameco, there's the big companies. You see that they follow, like Cameco's practically, there's like maybe three names that
Yeah.
follow the uranium price pretty closely, but all the other ones don't. They're not, there's no money going into them. So it's like you're hoping for 10,000, 20,000% gains, but
Yeah. You might not get it, but still, I don't think Chemical has done like 10x in the past 3 years. And that's impressive for such a big company as well. So
yes,
10x.
there's no, we think that something's big, but look, whatever the size of Cameco is, when you look at tech stocks, goodness, it's like
Teeny.
it's like a penny stock almost.
Yeah.
You're right. It's like there's nothing. It's like
I think Chemical is 20 billion, right? So it's like
yeah,
it's nothing.
yeah, 18 billion. It's like
Yeah, yeah.
nothing. Like I don't know what is a lot nominally. If they destroy your purchasing power, then that number is meaningless. You have to
Hmm.
measure Cameco in gold, measure Cameco in non-fiat denominated, because that 20 billion in your head, we're all making our, like, we're making X amount of money. We think that's a lot, but I remember when I used to work in IT, I had to buy software licenses for some servers, and oh, it's expensive. And I was trying nickel and dime, and my boss said, "What are you doing here? We're a we're a
Yeah.
multi-million dollar bank. We don't need, stop it." It's like you got to think big. Like, so Cameco 18 billion now, it could be 36 billion. And we think it's overpriced, but the money's piling in. Who cares if it's overpriced? It keeps going up based on like fundamentals,
Yeah,
People
exactly.
might not buy Cameco because on the fundamentals it's overpriced, but if the price keeps going up,
So does Chemical. Yeah.
that's right.
Yeah. True. But yeah, Patrick, I think that's a somewhat short video, but that's also what we agreed upon. So
Yes.
so yeah, thank you for your time, Patrick. And definitely I think the viewers will enjoy your take on things. I usually watch a lot of your stuff as well on YouTube and follow you on Twitter as I've done for the past 4 years. So so definitely guys, check Patrick out. I know most of you follow him anyways, and understandably so. So Patrick, thank you for being on, and we will maybe make one in the future again. We will see if we can schedule it at some point in time.
Yeah, that'd be fun. And
Hmm.
we could have you on our show there before sometime shortly there. That'd be great.
Yeah, sure. I will be happy to. I love to doing these videos and so on. So yeah, definitely. So
Awesome, man.
guys, as always, thank you for tuning back in, and give Patrick a thumbs up and follow him, YouTube, Twitter, all that good stuff. Look at his guns.
All
So yeah,
right,
guys,
man.
have a great one, guys, and we will see you in the next one. Bye, guys.
Ciao.